30 years of finding brands that capture a billion.
Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get to the headlines. Indian markets gain after witnessing a flat start. Nifty trades above the 10,500 mark, led by gains in auto stocks.
Vodafone Idea will raise about 25,000 crore to cut debt, leading to an equity dilution of more than 40%.
ING is looking to sell its remaining stake in Kotak Mahindra Bank via multiple block deals.
Yes Bank posts its highest intraday fall in nearly 3 weeks after its non-executive chairman, Ashok Chawla, steps down with immediate effect.
All right, let's get straight into the markets. Neeraj is here with us for an afternoon check. Afternoon, Neeraj.
Afternoon, guys. We're doing okay. 0.5% higher for the markets. It's not bad considering how we were for most part of the morning. We were just about flattish in the session. Now banks and rate sensitives leading the rally. So you'll see the Nifty Bank higher, certain auto companies higher, and as a result of that 0.5% uptick for the large caps. And frankly, the Nifty gainers will give you a sense of what's moving around. It is select auto and select banking names. Banks have actually, the private sector banks selectively have started seeing some of these buying come in since yesterday, because yesterday there was fairly good delivery based buying in stocks like ICICI Bank and HDFC Bank in particular as well. Today Kotak too marginally green, but the real action happening outside the index, or if we include a Yes Bank, then it's probably in the index too, but the real action happening outside the index. On the losing side, Vodafone India, slam dunk, 12% lower. The equity dilution and the fact that it's a significant equity dilution for the amount of money that the company wants to raise. The stock getting pummeled out of shape, 12% lower in trade. PC Jewellers post event and the numbers down about 9.5% too. Grasim incidentally has lost quite a bit too. Actually, so you would argue about 8.5%. Their consolidated numbers also didn't look all that great. Today, some of the consumption names, the likes of Page Industries, have come off and on fairly decent volume. So down about 5% for a Page. You don't usually see such a sharp move coming in on that one. And volumes compared to the averages fairly high, even though it's a relatively illiquid stock, but down about 5% in trade. On the flip side, gains for Ujjivan Financial post the numbers and fairly strong set of reported numbers for Ujjivan. Jet Airways continues to rise and shine on the belief of some bit of deal happening. Lots of dailies have reported this, so do watch out for this one as well. And some bit of gains for stocks like Siemens as well as CG Power. So a couple of those cap good names and power companies are in focus today.
Neeraj, thanks for that. CLSA's Chris Wood advises hedging against another oil price rally and waiting for the election results before buying Indian equities. He finds value in the Indian 10-year bond at 8% yields in the wake of the RBI's tight monetary policy. He, however, sides with the government in its tussle with the central bank in calling for materially lower interest rates, as he finds RBI's policy too tight. Listen into a slice of that conversation.
In terms of this current noise, media noise about the dispute between the RBI and the government, personally I'm more sympathetic to the government than some commentators, because the reality is the central bank has been running a pretty tight monetary policy in India in recent years, because my understanding is the central bank has an inflation targeting policy and they're targeting headline inflation. So if that's the policy, they're running very high real interest rates relative to headline inflation. So that, I think, is why they are vulnerable to criticism, because it looks like headline inflation has come down significantly in India, partly because of cheaper food prices, which I am told, I'm not an expert, reflects in productivity improvements in Indian agriculture.
Sure, but which is why they held interest rates the last time around, and they're probably most likely to do so this time around as well.
Yeah, but you could argue the rates could be materially lower in India. Now, if they're running monetary policy around concerns on the currency, then that would justify potentially having higher rates. But all I'm saying is there's a legitimate argument that monetary policy is being too tight, most particularly given that credit growth is weak and you have this legacy problem in the banking sector. So personally, I think monetary policy has been too tight. I think this argument of, the central bank being overcapitalized has some legitimacy. And I think anytime you can buy the Indian 10-year government bond at 8% yield, which you couldn't until a few weeks ago, is good value. So I think at 8% foreigners will come back and buy Indian bonds. So to me, the big risk in India right now from a bond currency point of view actually is external, outside the control of the Indian government. That's what we were talking about earlier. The oil price, one is the oil price, and two, how much more the Fed tightens.
Yeah, sure. So the recent fine print on the FII interest in the bond market has been slightly more positive. You've been seeing some buying coming back into the bond market. Do you see that likely continue?
I think if the US Treasury's yields peaked here, definitely. But personally, I would be a buyer of Indian 10-year at 8%.
Okay.
That to me is good value. And I think precisely because the RBI has been running a tight monetary policy, it makes Indian government bonds attractive.
At this juncture, would the strategy be to probably sit on cash a bit or deploy more in the equity markets?
No, I would be looking to buy them. But first of all, I would be buying bonds around 8%. So
over equities?
Yeah, now. No, I think if I didn't own any Indian equities yet, I personally would be waiting for the state election results and this commercial paper to be rolled.
Okay.
Because first of all, I want to see the commercial paper rolled. Everybody tells me it's going to be rolled okay, but you know, I'd rather just see it happen. And then the second point, I might as well wait for these elections because because there's obviously got to be a chance that the BJP doesn't do so well, because there's always a bit of an anti-incumbency sentiment in these elections, and that could trigger some nervousness, and then I personally would view that as an opportunity to buy.
How does all this volatility, according to you, play out for the currency and the impression that that creates externally? Because obviously with the currency weakening the way it is, the returns for foreign investors...
Yeah, but see, the currency having weakened so much to me is now a positive. If I'm looking to invest, that to me is a reason for foreigners to invest. Because I don't think the monetary policy is quite tight. To me, that's an opportunity, not a negative, as of today, because it's already weakened.
So a fair value of 70 to 73, natural course of the rupee.
Yeah, but if oil goes to triple digits, if oil goes above 100, which in my view is not impossible, clearly Indian rupee can come lower. So if I own Indian domestic equities, which I want to own, like the financials, in a portfolio, personally I want to hedge it with oil plays, with stocks that benefit from higher oil, because I still think there's a material risk oil can go significantly higher.
All right, on that point of the disputes between the RBI and the government, one of the points of dispute is the prompt corrective action framework. The government wants it relaxed, but data analyzed by Bloomberg Quint suggests that these banks are still very weak. Just in the September quarter, they reported 10,000 crore of losses, even though provisions are now starting to come to healthy levels. If you look at a 5-quarter period since the new framework was put in place, the cumulative losses for these banks are closer to 70,000 crore. Pallavi Nahata reports.
The government and the RBI do not see eye to eye on the prompt corrective action framework. This issue will be addressed at the RBI board meet next week. Ahead of that, we look at the performance of these banks over the last 5 quarters since the imposition of the framework. Large losses have continued for these banks. In Q2 alone, these banks reported losses of above 10,000 crore rupees. IDBI had the largest losses in this period. Losses have been because of slowing core income growth and large provisions. The good news is that large provisions have pushed up the provision coverage ratio for these banks. All of them are above 60% and some are closer to 70%. Despite that, net and gross NPAs continue to remain high. Net NPA ratio for banks is above the threshold of 6% used in the PCA framework. While IDBI has the highest net NPA, Bank of India had the lowest. Finally, it's important to understand the implications of this on credit growth. Data shows that all of these banks have seen a contraction in advanced growth between June 2017 and September 2018. However, at a system level, credit growth remains above 12%.
All right, let's move on. Vodafone Idea is looking to raise up to 25,000 crore. The two promoters, Vodafone PLC and the Aditya Birla Group, had earlier agreed to pare some of its over 1,12,000 crore debt in the company within the next few months. This will also lead to a substantial dilution in their equity holdings despite more capital infusion. Soumit Sarkar is here with the details of this capital raising exercise. Soumit.
So if you see, Vodafone Idea is planning to raise close to 25,000 crore rupees. Now, company did not mention why they are doing so, but analysts believe that this proceeds of this fund infusion will be used by the company to pay debt. Now, this fund infusion will be done via fresh equity shares, which would lead up to 41% equity dilution for the entity. Now, if you see, of this 25,000 crore, the promoter group, that is Vodafone and Aditya Birla Group, have committed to infuse close to 18,250 crore rupees, while the remaining 6,750 could be done via public issue. Now, if you see, the infusion, if approved by board, is expected to complete by the end of this financial year. Now, along with this fund infusion, the company is also considering the sale of its fiber assets to provide further balance sheet flexibility to the company. Now, the company has close to 156,000 kilometers of fiber routes across the country. Now, this proposed fund infusion of 25,000 crore would be the second one done by Vodafone Idea. Now, earlier in January 2018, the entities had infused funds of close to around 14,000 crore rupees in the respective telecom operations to pay debt and for the merger to go through. Now, this proposed fund infusion would lower the leverage ratio, which is one of the key conditions of this merger. Now, currently, if you see, the entity's net debt to EBITDA is close to 24 times. That's the highest in the industry when compared to the other two private telecom operators, that is Bharti Airtel and Reliance Jio. And post this fund infusion of close to 25,000 crore rupees, the leverage ratio of the company would come down to around 18.6 times, which would still be at an elevated level when compared to the other two players, that is Bharti Airtel and Reliance Jio. Now, the company also reported its first quarterly numbers as a merged entity. Now, we do not have the comparable numbers because it's the first time both the entities are reporting their numbers. Now, if you see, the second quarter was very weak for Vodafone Idea Limited. Now, the company's revenue were close to 7,700 crore rupees net. The company reported a net loss of close to 5,000 crore rupees. EBITDA came in at around 461 crore, while the margins stood at around 6%. Now, the average revenue per user was also the lowest for Vodafone Idea, close to 88 rupees per user. Lastly, the merged entity also provided around 1,000 crore rupees related to tenancy exit charges. Now, due to merger completion, the company had cancelled excess mobile towers, because of which the mobile tower companies had raised tenancy exit charges of close to around 3,000 crore rupees. However, the company is in discussion with these mobile tower operators and does not expect the demand to exceed 1,000 crore rupees.
All right, Samit, thanks so much for that. The ING Group plans to completely exit its residual stake in Kotak Mahindra Bank. Sources tell Bloomberg Quint that ING plans to sell this stake, which is about worth $1 billion, through block deals. Yatin Mota standing by with the details. Yatin.
We have source-based information that ING Group, which holds nearly 3.7% stake in Kotak Bank, is all set to sell its entire holding via multiple tranches of block deals. In fact, today morning also there was a block deal of nearly 1.7 crore shares, which is almost 0.7% of total equity, which has changed hands, and most likely it is ING which has sold to a clutch of institutional investors. Of course, we have ING Group, which held nearly 6.5% stake in Kotak Bank since 2014 after the merger of its Indian unit ING Vaisya Bank with Kotak Mahindra Bank. And, more importantly, they have been selling it gradually in the open market to meet their capital requirements back home. Sources have, told that the pricing and the quantum of block deals and equity will be determined, as per market conditions and feedback from institutional investors. As of now, it seems that ING is all set to exit its investments in Kotak in the next few weeks or so. Of course, when we contacted ING Group for a comment, they said that they do not, comment on market speculation and rumors.
All right, Jatin, thank you for that. Let's move on now. Ashok Chawla has stepped down as the non-executive chair of Yes Bank with immediate effect. He'd been on the board since March 2016 and has cited his inability to give enough time to oversee the transition as Rana Kapoor passes on the baton to the new MD and CEO as mandated by the Reserve Bank of India. Chawla is also the chairman of NSC and Reliance Nippon Life Insurance Company, a former finance secretary. His name recently cropped up in a charge sheet filed by the Central Bureau of Investigation in the Aircel Maxis deal.
It's been the worst quarter in at least 3 years for at least the listed airlines in India. The combined loss posted by the three players crossed 2,500 crore as their fuel bill kept on rising in the second quarter. Some of the pain was also inflicted by the airlines themselves, with all of them choosing to offer discounts to customers. Samit joining us with the roundup there. Samit.
Well, if you see the second quarter of financial year 2019 for the aviation companies was marked by higher crude prices, weaker rupee and lower ticket prices. Now, these three factors led to massive losses for all the three listed airline companies. In fact, the combined loss reported by Indigo, Jet Airways and SpiceJet was more than 2,600 crore rupees in the second quarter of financial year 2019, which is the highest reported by these three companies in the last 3 years or since when Indigo was listed back in 2016. Now, if you see, now let's see how these three factors impacted all the three airline companies in the second quarter. Now, if you see, fuel prices were higher by nearly 41% in the second quarter compared to last year, because of which Indigo's fuel cost per seat kilometer increased nearly 41.6%. For Jet Airways, it increased nearly 44.4%. Now, this is despite the fact that Jet Airways has most of its capacity deployed in the international routes, which enjoy lower taxation. And for SpiceJet, it increased by nearly 47%. Now, this could be because of its older fleet, which led to higher fuel burn in the second quarter. Now, ticket prices have been lower in the second quarter, and because of which the yields have been in pressure for the airline companies. Now, yields which measure the average earning per passenger per kilometer fell nearly 10% for Indigo. It fell nearly 6% for Jet Airways. Now, Jet Airways, it fell lower because of its international routes, while for SpiceJet it fell only 3%, which could be because of the regional routes that SpiceJet has in its portfolio. Now, if you see, the rupee depreciated by, on an average, depreciated by nearly 9% compared to last year, because of which, if you see the foreign exchange losses of these companies, Indigo's foreign exchange loss increased by nearly 7.3 times compared to last year because of rupee depreciation, while that of Jet Airways by 5.7 times and SpiceJet's 5 times compared to last year. That was the kind of jump that we have seen in the foreign exchange losses of all the three airline companies. Now, if you see the non-fuel cost, now, on the non-fuel cost, SpiceJet's non-fuel cost increased by nearly 15% compared to last year, while that of Indigo and Jet Airways increased by 14% and 9% compared to last year. Lastly, let's see which company has still managed to stay in green operationally. Now, Indigo was the only company which has managed to stay in green operationally, as it reported an EBITDA of close to 111 crore rupees, while the other two companies, that is Jet Airways and SpiceJet, reported an EBITDA of close to negative 272 crore rupees and negative 44 crore rupees.
Soumya, thank you for that. Let's move on. Indian Hotels reported strong growth in the first half of the financial year, and it expects to continue that momentum. The Tata-owned hotel chain, in fact, is looking to expand margins by 800 basis points by 2022. How do they plan to do that? Sajid asked that question to Puneet Chhatwal, the Managing Director and CEO of the company. Listen in.
The 800 basis points are just built on a normal growth in the RevPAR and the basic fundamentals in the industry, but becoming more efficient, having more management contracts, more fee-based business, which helps to increase your margin, monetization of some of our assets in secondary and tertiary markets, monetization of other pieces of real estate or land banks that we have collected over the years. This should help us in the 800 basis points. Anything which could be considered as a tailwind, especially on the side of the rates, has not yet been factored in. And there is a reason for that. The reason is, in the last 10 years, the rates have declined, even without accounting for inflation. So there is only
primarily because of supply, right?
Primarily because of supply. I think in the aftermath of Lehman crisis, what happened after 26/11, and as you said yourself, the supply increase was faster than the demand increase. So a lot of factors have led to kind of a rate decrease. It's not even a stagnation in the rates. So there is only one exception to that, and that is the Goa market. The Goa market, the rates have increased by 25%, but there are many markets, important markets in India, where the rates have decreased by 20 or 25 or 27%.
Can you name some of the markets?
Bangalore. From its peak of 2008 to days, Chennai is the second one. So Delhi is not doing better either, and neither is Mumbai. So the rates of 2007-8 were much higher than they are today.
But if you look at last 4 quarters, are you seeing the average room rates going up gradually?
Gradually, but at a very slow pace. I think they will eventually go up, because markets
you think it's a sticky thing, right? It's, rates going up, it's a sticky thing. It's very difficult to push the rates up in this market, or even though operating metrics for the industry is somewhat improving?
I would have preferred if you would ask me this question in 10-15 days from now, because this year the Dussehra and Diwali have come in the most important half of the year, because second half is when we have almost 65% of the total year's revenue coming in. So as we just finished with that holiday weekend, and we are only 2-3 days into the normal working, we don't have the full visibility. But I remain confident that the markets are strong, the fundamentals are strong, the occupancies have gone up. They're coming to the same level as 2008 for the Indian market.
Which is 80 plus?
No, it's around 2008, the Indian market occupancy as per Hotel Evate was at 68.8%, and now we are almost hitting 68.
For Indian hotels?
For Indian hotel market.
For Indian hotels
for
company?
Indian, not Indian hotels company, but for the Indian hotel market in general. So once the occupancy gets back, the trend internationally in this business has been then the rate starts to follow. So we have not yet witnessed it in that kind of form, but I think the next few weeks will be decisive on that front.
And how are occupancy rate for you? Means how has it been?
We have done quite well. You know, we have in the first half.
Above 68, above industry.
See, the industry in India has gone up by 3.7%. Again, as per the same source, and ours have gone north of 8%.
Okay.
And that is the RevPAR growth, and the majority of it has still been driven by occupancy and not by rate. So I think that upside we will see. On the other hand, I have to say that a majority of our portfolio, especially with the Taj brand, is coming at a very high base. If you're in a mid-market or a kind of a upscale kind of positioning, the probability of getting a much higher rate increase is higher. But if you're selling a palace or if you're selling a safari already at those kind of prices like we do, then the rate increase in a percentage level will not be that significant.
Okay, your pipeline also has gone up by nearly 90%, right, over last year.
Correct.
You have a target of achieving 25,000 rooms by 2025,
Correct.
if I'm not wrong. How do you plan to achieve that? There has been a couple of properties which you have gone into in the last 1 year or 6 months, 15 odd properties which you have done. But as you go forward, what is the kind of business mix which will be there, ownership versus management contract?
I think our ambition is to have a balanced portfolio so that our owned and leased portfolio is 50% and the 50% is managed portfolio. We don't want to be only a fee-based business company. I think the kind of leverage and the kind of profitability we have from some of our owned assets like the Taj Lands End, or we are sitting right now in the Taj Mahal Palace and Tower in Mumbai, you need like hundreds of franchise or management contract to come to that level of income. So I think we are going into fee-based growth more to increase the margins, so we have a more balanced portfolio, so we are better hedged in volatile situations when the markets go down, and I think that's a good way forward for Indian Hotels Company.
And which are the segments where you see that kind of margin expansion coming in, because you have multiple segments within?
So you can expand margins in any kind of segment, but the highest margin you can achieve is at the bottom of the pyramid. That is with the Ginger brand.
And we've been expanding Ginger as well.
We have been expanding
Ginger
aggressively. We have revamped the Ginger brand. The launch of the new Ginger digitally has already happened on the website, and physically is happening next month with our existing Ginger property in Panjim in Goa. So after that, Whitefield in Bangalore will come. So we are very confident that Ginger will be very attractive brand for the majority of the people on the Indian subcontinent. But at the same time, when the markets bounce back, then our ownership position in many of our assets will help us really grow the margins, especially if the markets were also bouncing back on the rate.
A global equity rout coupled with domestic macro concerns prompted foreign portfolio investors to pull money out of India for a second consecutive quarter. But there are a select few names where they're committing more money. Yash Upadhyay is standing by with a list of stocks where FII holdings have changed dramatically.
So for the purpose of this analysis, we are considering the BSE 500 as the universe, and we have added the criteria of stocks wherein foreign investors have increased their holding by 0.5% or more. And that brings us to a number of 93 stocks wherein they have increased their holding, and about 1/4 of that, or 123 stocks wherein they have reduced their holding. In terms of which are the top 5 stocks wherein they have increased their exposure, topping the list is AU Small Finance Bank, wherein they have almost doubled their holding since the June quarter, from 10.23% to as high as 20.63. Another name wherein they have doubled their holding is Greaves Cotton, going from 6.92% to 12.16. The other key names over here being Zensar Tech, Mahanagar Gas and Tejas Networks. However, out of the 123 stocks, let's also take a look at which are the top 5 stocks wherein they have reduced their holding substantially. And an interesting name, Vodafone Idea, that tops the list, India's largest telecom subscriber, telecom service provider. There they have reduced their holding by almost 13 percentage points. So it went from about 26% in the June quarter to as low as 12.35%. The other key names, the usual suspects, PC Jewelers, PNB, that has the lowest holding of foreign investors. So it's gone from about 8.5% to 3.72% as of the latest September holding. And the other names include Balrampur Chini as well as Manpasand Beverages.
So Yash, specifically for these 5 stocks that foreign investors seem to be interested, what is working for them?
Right. So AU Small Finance Bank tops the list, and almost 10 out of the 15 analysts tracking the stock, they have a buy rating with a return potential of almost 30%. It recently got included in the MSCI Small Cap Index as well, on the back of which we saw a big up move yesterday. Zensar Tech, 8 out of 11 analysts have a buy rating. Tejas Networks, 100% of the analysts tracking it have a buy rating, and it also has the highest return potential of almost 47% from its current target price. And Greaves Cotton as well, 6 out of the 9 analysts tracking it have a buy rating. But let's try and also understand that what is working for each and every one of them. For AU Small Finance Bank, it has seen a strong 42% CAGR growth over the last 2 years, led by the increasing penetration and gaining of market share from informal sources and NBFCs. Going forward, its customer-oriented business as well as its capability to build post its expansion, that should augur well and be the key growth driver going forward. When it comes to Zensar Technologies, well, the continued focus on its core business, that is aiding the company, as well as the fact that it has seen a strong momentum in its digital services segment. Close to 43% of the company's revenue come from this segment, so it is a big positive, along with large order wins and the revival in the IMS business as well. For Mahanagar Gas, well, the city gas distribution business is a monopolistic business, and they hold exclusive infrastructure in Mumbai, Thane and Raigad. Also, the government's move towards clean fuel, that is likely to aid volumes going ahead. The company also enjoys a considerable pricing power, so it is able to protect its margins, and given that it is also the cheapest energy stock and is trading at the lowest valuations. For Tejas Networks, the industry that it operates in, that has seen an exponential growth in data traffic, and the company is well positioned in terms of its robust portfolio of data and optical networking products. It operates on an asset-light business model, and also the fact that it has an edge over its larger global peers when it comes to receiving orders from the government and PSU sectors because of the Make in India initiative. Lastly, taking a look at Greaves Cotton, the management has been taking active steps towards reducing its costs and has been expanding its operations in the aftermarket sales. Its recent acquisition of Ampere, that could boost the share of non-auto segment and also increase the share of its B2C business as well.
Thanks for that, Yash. Out of time on the show. Thank you so much for joining us.